Hello and welcome back to All Things Money. I'm your host for the show, David Blain. We thank you for joining us today. During this segment, we're talking a little bit about some of the things that you can control. The financial markets, there's a lot of volatility, meaning a lot of up and down, a lot of fear, and frankly, some panic going on in the market. The news shows, if you watch cable or Fox News or CNBC or MSNBC, you know, there's a lot of anxiety building out there about what's going on in the world and financials. And I'm not to say that you should bury your head in the sand and not think about these issues, but a lot of people overly obsess and worry about things that they can't control. If you've got a problem with it, sure, go out and vote. Join an organization that promotes your political stance. Do those sorts of things. But when it comes to investing, as I mentioned last segment, you don't have any control over whether that investment goes up or down on a daily basis. But what you do have control over is certain things. And so we want to talk about some of those things that you can do. And number one is don't react emotionally. We talked about this when the whole debt downgrade. If you're a day trader, stick with day trading. If you're a long-term investor, stick with being a long-term investor. The key to investing is have some sort of discipline and stick to it. We happen to think that there are certain principles that, over time have proven successful, that we would encourage people to follow. Not day trading, not short-term trading. However, if that is your focus, fine. Don't change your mind every week about what your strategy is. Don't be a long-term investor one week, the markets go down, and then all of a sudden decide you're a day trader. That if you've got to have some sort of investment discipline and stick to it. And frankly, that is the value that most advisors bring to the table, is especially in our firm. Our goal is not to have this great outperformance. It's our view that, on average, the majority of the funds out there are not going to outperform, a broadly diversified portfolio. And so we opt, to construct broadly diversified portfolios. But where the value comes in is having a discipline, having a process such as we do in place that is prepared for different economic scenarios and that does reasonably well in all sorts of different kinds of economic climates. It's that discipline that allows people to accumulate wealth over long periods of time, the discipline to save, the discipline to invest, the discipline not to react emotionally. We're not saying that if your strategy is, if the market goes down 10%, to sell everything, well, if that's your strategy, what we're saying is that stick to it and stick to it religiously, that you'll probably be better off in the end than continually changing your strategy. We're not saying that's a great strategy to begin with, but it's certainly a better one than keep changing your mind. Most people lose out in the financial markets because they're continually chasing the latest hot strategy, the latest thing. We have had gold in our portfolio for a number of years, and have done quite well in it. What I tell, it makes me very nervous today when a new client comes in to put them into gold at the prices today. We're not saying it won't go higher. It's just the risk level is much higher than it was 5 years ago. And so if you have a discipline to invest in asset classes and to rebalance or something, and you continually follow this, you're going to come out much better than, okay, today you're going to chase gold, and 5 years ago you were chasing real estate, and 10 years ago you were chasing tech stocks. You're constantly going to be losing and getting into these bubbles. And so it's better to have a disciplined strategy that you lay out when things are calm, write it down. We develop investment policy statements for all our clients where we lay out what are your goals, what are your objectives, what are the risk factors involved, and we lay out a strategy to meet those goals. And so we find virtually nobody panicking because they know that there's a strategy in place. We've set up the portfolios such that they can tolerate these ups and downs, and we don't receive panicked phone calls when the market goes down, because we've set out ahead of time what the purpose of the portfolio is. So it's very important. Don't react emotionally. Have a plan in place for your investments. We see people come in all the time and they've got, an account over here, an insurance product, some annuity over here, and some fund over here, and a fund here, and a stock, an individual stock here, and a bond. There's no coherent strategy. They've got a little account here for their kids' college, and an account at work, and there's no coherent strategy. And then it becomes overwhelming for people. And one of the benefits that we offer is to simplify this. One of the comments we hear all the time from people, among other things, is, gosh, David, we really appreciate you helping simplify our financial life. And so that we understand where we are, we understand what we have, we understand the return that we're getting. And there's a lot to be said for that, simplifying your financial life and having a plan in place, not reacting emotionally. Those are the first three things that you have control over. Get control of your emotions, get control of your plan, and simplify your finances. And those three things alone will bring a lot of peace to yourself, and you don't worry about the markets as much and what's going on in CNBC and so forth. It's just taking those simple steps of things that you can control. That's don't react emotionally, simplify your finances, and have a plan. Well, we'll give you some more tips dealing with this extreme volatile market when we come back after a few short messages.